Problem one in that you face as a trader in recognizing key support resistance levels are as follows. I got a little visual diagram here, and basically on the left is a trader trading off a 60-minute time frame. This is his trading time frame. Some traders trade off 1 minute, 5 minute, and so forth. For example purposes, we're going to say it's a 60-minute for now, but it could be any time frame that you like it to be. The trader recognizes there is a trend. He puts a pullback trade at the black solid line because he recognizes that to be a major support. The stop then is going to be a buffer below that black line, which is, it's not there right now, but it's basically the stop will be a buffer below the black line. And basically what he's looking to do is enter at the black solid line, purchase this, and then he looks to least for price to retest the pivot high. That is the goal for the trader. Instead, what happens is that price breaks the support, it goes down to his stop, as you can see here, and then takes off in the direction that he had planned it to go. So what happened? He got clipped basically in this trading scenario. Has this happened to you? It has happened to every trader out there, believe it or not. You can't really call yourself a trader unless you've gone through this at all. So what did you do wrong? A lot of people ask this question. A lot of people think, well, do I need another indicator? Did a broker play games with me? Are there some other thought process that may occur in the trader's mind? The only question you should be asking is, why did this occur? A lot of people come up with excuses, but they really can't figure out why this occurs. Today you're going to know why this occurs, and I'm going to show you through some visual illustrations on what happened. For this example here, what happened? In this example here, you had your support and then you got stopped down in a 60-minute. Then you have the daily time frame. So in this situation here, price went to the daily support, which is exactly where the 60-minute trader had to support the stop. It got to the daily support and then bounced off it, and price resumed the bullish trend. In this case, the higher time frame support overrid the 60-minute support. The long-term traders decided to show up to trade on the pullback, and they came in with a lot more volume compared to the 60-minute trader. Based on this, a trader will assume the higher time frame is always important and critical. Okay? And this is pretty much a notion that a lot of people think that you should always trade with the higher time frames. Well, that's one situation. The second situation could be is where you have your pullback trade on the black line, but what happens is price never got to that level at all. Instead, it stopped midway and then it decided to take off. So what happened in this situation? You didn't lose anything, but you never entered the trade at all. In this situation, what happened is that price stopped midstream because that's where the 30-minute support was. So in this example here, the lower time frame was basically the dictating time frame that controlled the support. Price decided to respect the 30-minute support instead of the 60-minute support. The day traders decided to show up to trade, whereas the swing traders and the long-term traders didn't trade with volume to influence price, so the day traders won as far as the support is concerned. So you have two different situations here. Problem one was where basically the higher time frames controlled the trade, controlled the support. Problem two, it was a different situation in that the day traders, the lower time frame, controlled the support. So you have two different thought processes that are going on. So which one is correct? If looking at both situations, you have some randomness that's going on. You don't know what type of trader is going to show up to trade with volume and influence the instrument. There's no statistics, believe it or not, behind it. In order to trade the probabilities, you have to assign rules to randomness, and that's what you call a trading plan. In order to resolve this situation, we're going to look at the 30, 60-minute, and daily support to be the same. So what we want to do is, if it is the same support for all three of those time frames, then you have a multiple time frame match.